Hey guys, welcome back to the channel. My name is Leo, and in this video here, we're going to be doing an analysis on Peloton, the exercise bike company, going through a lot of different changes. They laid off 2,800 employees, CEOs changing it up, a lot of news surrounding this company, and yeah, without further ado, let's get into it. Before we jump into the video, I want to remind you to hit the like button and hit the subscribe button if you like content like this. It helps out the channel a lot and makes me feel warm and fuzzy inside. So smash that like button, hit the subscribe button, and here we go. This is Peloton. Let's start off with the company metrics category here. So Peloton, the $9 billion evaluation, it was very popular. Start of this pandemic. We go a 3-year chart. Look, you can just see the price. Yeah, look at that. Beginning of 2020, low 30s, and then immediately shooting up while everybody was at home. Got to a price point of, what was it? The 167 or so. And then, yeah, now we're down to 22 low. 22 was our lowest point in the 52-week range. Okay. Wow. Quite the drop-off. I mean, their bikes seem super expensive. Anyways, let's get into it. So we got a $9 billion company here. Let's look at our company metrics and compare, see where Peloton stands. Right off the bat, not looking too healthy. Negative PE, negative average PE. We want that to be under 22.5, and we have that, but not. We want this number to be positive. So it's a negative there. EPS negative on both fronts. 5-year average. Return on equity trailing 12 months negative 35% and negative 3. We want this to be over 15%, and we haven't hit that number. Guys, we don't have a single positive number on this company, with the exception of our revenue. Profit margins negative 15% compared to negative 14 as the average. Revenue's been $4 billion. Our net income is negative 634. Free cash flow is negative 139. Our average is negative 94 million. Return on invested capital is negative 19, and the 5-year average is negative 4.73. We want these numbers to be over 10%, and clearly we are not hitting those numbers at all. Almond Z score, it's at 2.43. We want this number to be over 3, so that's not looking too great. This is just an indicator to see how well or how safe the company is, if it's going to be approaching bankruptcy in the next couple of years. Under 3 and between 1.8 and 3, the company is in a gray zone. So that's where Peloton currently is. Yeah, not too happy with this company so far. And Piotrowski score is 2. That's terrible. We want this number to be 9. Or 9 is perfect. We want this to be 8 or 9. I'll even take a 7. But right off the bat, Peloton, just going through this category here, to me, it just screams, doesn't make money. Next. All right. Jumping forward, let's go into our financial evaluations. We have a score of 3. Let's go through those categories right now and kind of run through what we have here. PE 5-year average negative 192, as we expressed over here. We want this under 22.5. It's beneath 0, so that's a no points. Current ratio 1.96. We want this to be over 1.5, and that just shows how much liquidation the company has on hand in terms of its assets compared to liabilities. So it could cover its liabilities with its assets, and it's at 1.96, so it's not bad. Surprisingly though, considering where revenue, net income, and free cash flow. Return on equity average negative 7. We want this over 15. Not happy. EPS growth there's been a decrease. 5-year average has been negative 0.54 compared to negative 2.2. So we're actually losing money on earnings per share. Debt to equity, we want this underneath 5. We want this number to be under 50%. It's at 82. That means they're taking on more debt to leverage their capital in the company instead of building equity within the business. That's not good, folks. Share dilution. Peloton is diluting the hell out of their investors. 33% increase in the last, I guess, well, the average is 5 years. Have they been public for 5 years? When did they go? No. No, they haven't. Did they just go public in 29 end of 2019? And there's okay. So correction on a lot of these evaluations, guys. This is gonna be this is the average of since they've been public. So keep in mind, within the 2 years that they've been around, they've issued 33% more shares. That's not good. They're diluting you as a shareholder, and that's not healthy. We want this number to be decreasing, staying the same or decreasing. So it's amazing that the debt to equity is that high, considering they probably were issuing shares when this price was skyrocketing. Because why take on debt when you can just have your shareholders purchase up all your shares and build equity through that way? Especially if you're one of the investors that bought here in the 160 range. Ridiculous. 5-year net income growth, negative 165. All right, terrible. The free cash flow has actually been increasing. So, I mean, we still have a negative number, but I guarantee it's been increasing. So it's technically moving in the right direction. So it's going to get a point here. However, when you compare it to what the company metrics are, we're still in the negative. We want this to be positive. So until this actually gets into the positive numbers, I'm counting this as a 0, to be honest. 5-year return on invested capital average, negative 4. We want this to be over 10 or higher. And 5-year revenue growth, 105% increase. So I'm gonna say we're going based off 2 years here. I mean, it's in the positives, so that is technically a point. I would imagine we hadn't. Yeah. Well, it's still a positive, but this number should really be a 2 out of 10. They just have the current ratio and their revenue growth. Other than that, this company is not really generating money. I don't understand how it climbed to that price. Man, what would that put it at before? Because now it's at $9 billion value. How is this evaluation does not make sense at all. Either way, I digress. Let's jump into the price analysis and see what we should be paying for Peloton. This company, I don't know. It's just an iPad, right, on a bike, or is this something more? I mean, like, what's the difference between getting just an exercise bike and get a flat screen TV or something, and Netflix? I'm pretty sure it costs less than one of their bikes. Anyways, let's take a look. Revenue numbers. We got crazy amount of numbers to work with. I'm going to be conservative. And let's say we'll do a 10-year evaluation. Let's see. 10 years. What's a reasonable number? 30? We'll do 35, 40. Because there's no way they're gonna like that. Even this is being not really conservative, but sure, we'll run with it. Profit margin 0. They don't make money. How about we do? Let's go off. We'll go let's do this to 20%. Free cash flow margin. Let's do the inverse of what we have here. Instead of like -4, we'll do 4. We'll do 12. And then we'll do 15. I'm really pulling numbers out of a hat here, guys, just because the company doesn't have much going for it, to be honest. Like, this is a company I wouldn't even take a look at. I would skip. Free cash flow, or price to free cash flow. It should be a higher growing company, so I'm gonna go 17. Okay, how about this? I'm gonna price it as if it started making money next year. So let's say if it starts making money, yeah. So if it starts making money next year, let's do 15, 16, 18. PE, we'll do 14, 16. Let's do 14.5. I don't know. I'm feeling like a 14 point. Desired return, we'll do 13%. See how that looks. All right, guys. So, as you can see here, these numbers are quite insane. Based off of these parameters, if you believe these numbers here, this category is like the unicorn. This would mean Peloton is a buy all day. This category is wishful thinking, because we have a buy price of 53, and assuming the company makes no profit, assuming the free cash flow margin percentage is at 4%, and assuming it's going to be growing at 30% revenue growth for the next 10 years. And the PE ratio will be 14. And the price to free cash flow is also 14.5. This is a wish list because none of these numbers exist in this category. None of them. So if I do 0, hypothetically, oh, that just changes everything. That just makes everything gone. If I do 2, yeah. To be honest, I wouldn't even. I'm gonna just clear this because you know what? This is a company I'm not gonna even touch. I really can't do an evaluation of what to pay for this company because it doesn't make money. It doesn't generate anything. I need this company to be on the market for another couple more years to actually get a proper evaluation. I would just be avoiding this company for the next little while, especially with the pandemic kind of coming to an end, where gyms are opening up and most places are opened up. People can go back to their gyms and work on their exercise bikes, have the weights in front of them. People are not investing heavily into their home gyms. So what is the justification to owning one of their products? That's the way I think about things. But this is a first for everything. I'm gonna just say that in regards to Peloton, my opinion is I think just to completely avoid it. It's got negative free cash flow, negative profits, negative everything across the board. Is the company going to grow 100% revenue per year? Highly doubt that. That's an absolute insanity. 30% revenue growth is a conservative number in this aspect, but not realistic. Until this company starts generating a profit and generating positive free cash flow, then that would be something to look at. With that being said, folks, if you found this video helpful, please drop a like, hit the subscribe button for more content like this, and leave a comment down below of a company you would like to see evaluated. If you like the program that's on my screen here, this lovely software will be available soon as an app for your phone or through a web app, currently in development. But yeah, shoot me a message and we'll get you on a list and hopefully make it available to you soon. That being said, folks, have a good one. See you in the next video.